Okay, let's take a look at exercise 9-15. Now what we're doing here is we're going to indicate the effect of each of the following transactions on the current ratio, on working capital, on stockholders' equity, book value per share, retained earnings, and also retained earnings, okay? And we're supposed to assume that the current ratio is greater than 1.1. Now here's the transactions listed here, and I've put some definitions on the screen for you. Current ratio is current assets divided by current liabilities. That's how we calculate it. Net working capital is current assets minus current liabilities, and book value per share is calculated by taking total common stockholders' equity and dividing it by the number of common shares. All right, so let's look at the first transaction. What does it say? It says collected accounts receivable. Okay, when we collect accounts receivable, what happens? Well, cash goes up and accounts receivable goes down. Both of those accounts are assets. So we can sort of think through what happens on the current ratio. Did current assets increase? No, one went up, one went down, so it stayed the same. Did current liabilities, did it change? No, so there's no effect on current ratio. So we put NC for no change. Working capital, did current assets change? Nope, one went up, one went down, no effect on liabilities, so there's no change there. Collecting accounts receivable has no effect whatsoever on retained earnings or anything else in stockholders' equity, so we have no effect there, right? And it doesn't change the common stockholders' equity, it doesn't change the number of common shares, so there's no change there as well. Okay, now let's take a look at transaction D. We purchased inventory on account. Okay, when we purchase inventory on account, what happens? Well, inventory increases. That's a current asset. So current assets are going to go up. What about current liabilities? Well, it goes up too. Accounts payable. We owe that money to someone. But we're seeing here that the current ratio goes down. Now, you may be wondering how that works. Let me explain that. Okay, now I've slid over where I'm going to illustrate this. Let's assume that our current assets were 20 and our current liabilities were 10. It could be 20,000, 20 million. That's just what we're going to assume it started with. And let's assume we purchased 5 million. If these are in millions, we purchased 5. So 20 is going to become 25. Oh, by the way, the current ratio. I should make this a little bit wider so you can read it. Okay? Current ratio is 2, right? 20 divided by 10, and I am doing this in Excel. You just can't see the rows and columns, and I've hid the grid lines. Okay? So if we purchased 5 on account, if it's 5 millions, 20 will become 25, right? So this will become 25, and current liabilities will become 15. Now remember, we started at 2, and what happens? Because we increase the current assets and the current liabilities equally, and because they told us we started at a ratio of greater than 1 to 1, mathematically the current ratio would have to drop. Okay? And that's why current ratio goes down. Okay, now sliding back over so you can see the question. What's the impact on working capital? Well, working capital is current assets minus current liabilities. Both went up by 5, so there's no impact. Well, in my example, but the point is both would go up by the same amount, so it has no impact. Stockholders' equity, the purchase of inventory doesn't affect income or anything else in stockholders' equity, so there's no change. Same thing. No impact on common stockholders' equity or the number of shares. And since it didn't affect income, that gets carried over to retained earnings. There's no change there. Okay, so this is sort of the logic you need to go through to determine which of these accounts change, whether the impact is an increase or a decrease.